Investing can be overwhelming for beginners, especially when faced with industry jargon. Among the many terms, one that frequently appears is the total expense ratio, TER. Understanding what TER is and its implications on your investments is crucial for making informed investment decisions. In this video, we will delve into what TER is, how it is calculated, and its significance. This is the Bullish Aristocrat. And in this channel I would like to share my investing journey, and give you all the tips and advice I wish I knew when I first started investing. So if you find that interesting, then please subscribe to the channel and like this video to help support us in reaching more people. Make sure to press the notification button to stay up to date with new videos that will be uploaded. So what is the total expense ratio? The total expense ratio is a measure of the total cost of investing in a particular fund. It is expressed as a percentage of the total assets invested in the fund. The TER includes all expenses associated with running the fund, such as management fees, administrative costs, and other operational expenses. The TER provides investors with a simple way to compare the costs of different funds. However, it's important to note that TER does not include any costs associated with buying or selling shares of the fund. These costs, such as brokerage commissions, are not part of the TER calculation. The TER is calculated by dividing the total expenses of the fund by its total assets. For example, if a fund has total expenses of €10,000 and total assets of €1 million, its TER would be 1%. But why is the total expense ratio important? TER is a critical factor to consider when investing in a fund because it directly affects your returns. The higher the TER, the lower your returns will be. This is because the TER is deducted from the fund's assets, reducing the total amount available to generate returns. Therefore, the lower the TER, the more money there is to generate returns. In addition, TER is an ongoing expense. It is charged to the fund on an annual basis, regardless of whether the fund is performing well or not. Thus, even if a fund does not generate a high return, you still have to pay the TER, which could significantly affect your returns. It's worth noting that the TER can vary between different types of funds. For example, actively managed funds tend to have higher TERs than passive funds, such as index funds. This is because actively managed funds require more research and analysis, resulting in higher management fees. To better understand the impact of TER on your returns, let's consider an example. Suppose you are considering investing in two different funds, Fund A and Fund B. Fund A has TER of 1%, and Fund B has TER of 2%. If you invest €10,000 in each fund, Fund A will deduct €100 in expenses, leaving you with €9,900 to generate returns. On the other hand, Fund B will deduct €200, leaving you with only €9,800 to generate returns. In this scenario, the higher TER of Fund B results in a lower amount of money available to generate returns, leading to lower returns overall. Therefore, it's crucial to choose a fund with a low TER to maximize your returns. In general, TER of 1% or lower is considered reasonable, while anything above that is considered high. I personally prefer to invest in funds that have TER of anything lower than 0.5%. You can even find ETFs with a TER as low as 0.07% such as the S&P 500 Index Fund. When evaluating ETFs, it's important to understand why they may have varying total expense ratios. Several factors contribute to the differences in TER among different ETFs, including fund complexity, management style, tracking methodology, fund size, and securities lending activities. Firstly, the complexity of an ETF's investment strategy plays a significant role. ETFs can employ different approaches, focusing on various asset classes, sectors, or regions. Some ETFs require active management, involving extensive research and analysis, which leads to higher costs. These active strategies often have higher TERs compared to passive ETFs that track broad market indexes with minimal ongoing management. The management style of an ETF also impacts its TER. Active management involves fund managers making frequent portfolio adjustments in an attempt to outperform the market. This active decision-making incurs higher costs, such as research expenses and transaction fees, which contribute to a higher TER. On the other hand, passive ETFs that track indexes generally have lower TERs since they require minimal ongoing management. The tracking methodology employed by an ETF is another factor influencing its TER. Some ETFs aim to fully replicate a specific index, holding all or a representative sample of the securities in that index. This approach incurs higher trading and operational costs, resulting in a higher TER. Alternatively, ETFs that use sampling or optimization techniques to track the index may have lower costs and, consequently, a lower TER. Fund size is also a factor to consider. Larger ETFs often benefit from economies of scale, as the fixed costs of running the fund can be spread across a larger asset base. This leads to lower operating expenses and a lower TER. Smaller ETFs, especially those with limited assets under management, may have higher TERs to cover their proportionately higher operational costs. Additionally, some ETFs engage in securities lending. Securities lending involves lending out a portion of the ETF's holdings in return for collateral, earning additional income. The income generated from securities lending can help offset some of the fund's expenses, potentially leading to a lower TER. However, securities lending introduces additional risks and complexities, which may be reflected in the TER. While a lower TER is generally favorable, it's important to consider other factors when selecting an ETF, such as the overall investment strategy, track record, and potential returns. Investors should also be aware that TER is not the only cost associated with investing in ETFs. Transaction costs, bid-ask spreads, and taxes can also impact the total cost of owning an ETF. In conclusion, the TER of an ETF can vary due to factors such as fund complexity, management style, tracking methodology, fund size, and securities lending activities. Understanding these factors helps investors make informed decisions while selecting ETFs that align with their investment goals and risk tolerance. Evaluating the overall value proposition and potential returns of an ETF alongside its TER is crucial for making well-rounded investment choices. Thank you so much for watching this video till the end. If you found it at all helpful, then please hit that like button and subscribe to the channel to always be up to date with new videos that will be posted weekly.